Santiago Investment Advisors event, Standing on the Shoulders of Giants, which I think hopefully the title will become apparent later on. So, a couple of things. The talks are being videoed over there, and the talks are also being live drawn by Philip Barrett up on the top there. So when we're finished this evening, Philip will show off his great work. So we're all looking forward to that as much as the talks. So without further ado, I'm going to introduce Anatole. And after Anatole speaks for 30 or 40 minutes, we'll have a panel discussion with the other members of the Investment Advisory Board. So Anatole, I think what we had on the invite speaks for itself. Founder of GavCal, Chairman of the Institute of New Economic Thinking, contributing editor of the Project Syndicate, among many other things, and a wonderful speaker. So, Anatole, delighted that you're here this evening.
Well, thank you, Ronan, and it's a great pleasure and honor to be speaking in such a beautiful and distinguished-looking place. I'm a little baffled, I must say, by the name. Actually, I meant to ask you about this, Ronan. How is it the Royal Irish Academy? I thought you were now in a republic, so what is the history of it? And that brought to mind, and I think that I'll use this as an introduction to the basic subject that I've been asked to talk about, which is, how do we reconcile the chaos and the political chaos and unpredictability in the world with what's going on in financial markets? But how do we reconcile this beautiful building still being called Royal in Ireland? And I think this brings to mind, one of the strangest things that's going on right now, which is the reversal of roles between Ireland and the United Kingdom over the last year. The obvious being what's going on with Brexit, and I'm not going to talk, in fact, I think this may be the only thing I say about Brexit until perhaps we get into the Q&A discussion right now. But the extraordinary political reversal of roles that we've seen in the last 3 years and in the last 6 months in particular, where it is the Irish government that is telling and forcing the British government to really march to dance to its tunes rather than the other way around. But this actually also reflects, as do a lot of events in politics, an important and interesting underlying economic dynamic. And that is the fact that Ireland is now one of the richest countries in Europe, and certainly compared with the United Kingdom, is now, depending on how you measure it, 20 to 40% richer, more productive, better off, and therefore on a per capita basis, economically arguably more powerful than the United Kingdom, a dramatic reversal even from 20 or 30 years ahead when I first, 20 or 30 years ago, when I first started coming to Ireland, I think in the mid-1980s as when I was a full-time journalist working for the Financial Times as a visitor of your Industrial Development Authority, who were just starting this process of opening up and internationalizing Ireland, which has turned out to be so successful. But as I say, this reversal of roles between the United Kingdom and Ireland in particular is confusing. Certainly not what I think anybody would have predicted back in the 1980s. And we're living in a period of lots of confusing and even unprecedented events around the world in politics. The Trump administration, the chaos of Brexit, Boris Johnson being Prime Minister, the alternative to Boris Johnson in Britain being Jeremy Corbyn. These are all completely unprecedented events politically, and lots of unprecedented events in the markets, negative interest rates. People, I think you haven't quite got to this point in Ireland, but you're probably not far from it. But in Denmark and Sweden, buying houses borrowing money from the bank and actually getting a check from the bank every month to pay their mortgage interest, because mortgage interest in Denmark and Sweden is now paid by the bank to the borrower instead of from the borrower to the bank. What a topsy-turvy world. And yet, in this very confusing and chaotic world of economics, politics, and even markets, many investors, I hope including many of you here, have found it a very profitable period. The world economy has now been in a period of uninterrupted expansion for over 10 years, starting in the middle of 2009. Something that almost nobody predicted at that low point of the financial crisis in the first quarter of 2009. Stock markets all over the world have also been rising, either very, very rapidly, as in the US, or in a more erratic and gentler fashion, but nevertheless rising significantly over the last 10 years throughout the world. And certainly for American investors, this has been the longest ever period of uninterrupted economic expansion, and also almost now, well, both the longest and almost now the biggest bull market gain in asset prices in the stock market. So how can we reconcile this chaos and unpredictability in politics and in underlying economics with the profits that we see, incidentally, not only in the stock markets, but in the business community? Profitability in many sectors, in fact, in most sectors of the world economy, and certainly in the aggregate, is at all-time highs. Profit margins are at all-time highs. Employment is growing, has grown very rapidly in America, Britain, and here in Ireland, but even in Europe, employment is now approaching again the levels of the pre-crisis period, and unemployment is down. So how can we reconcile this? Well, what I'm going to suggest in the next 25 or 30 minutes is a very long-term picture of how we can explain the combination of political and policy chaos and unpredictability and really quite decent economic and financial conditions. Then when I say long-term, I'm talking about generational, 40, 50-year view. Then the medium term, by which I mean 5, 10, 12 years, and then, which is probably what really interests those of you who are very active in as investors, the short term, i.e. what's likely to happen and what has been happening on a 1 to 2 year timescale. So first of all, let me say briefly about the very long-term picture. I think it's actually not surprising that now, 10 years after the biggest financial crisis in some of our lifetimes, I see a few gray hairs around here and people as old or perhaps even older than me. For us, it's perhaps not the worst crisis, financial and economic crisis we've lived through, because we remember the mid-70s and early 80s, but it's certainly one of the worst crises in our lifetimes. How we can reconcile that with really pretty decent economic conditions, which very, very few people back 10 years ago predicted. Well, I think actually there is nothing surprising about this. I would say this because 10 years ago, actually exactly 10 years ago, in November 2009, I started writing a book which was published about 9 months later in the summer of 2010, which I called Capitalism 4.0. Now, it's a 450-page book, so I won't try to summarize it in detail, but I think it's a book, which did reasonably well, but didn't have a particular impact, but which was actually somewhat ahead of its time in predicting and saying that, yes, we have had one of the worst crises in capitalism in its history, not just in our lifetimes, and I'll come back to that, but we should expect from now on to have a steadily and perhaps rapidly improving situation in the world economy, combined with a steadily and rapidly deteriorating situation in global politics and in the understanding of how economics works. As I said, this book was perhaps a bit ahead of its time, which can be a euphemism for just plain wrong. But I think in hindsight, this is actually what's happened. We've had a decent economic performance now for 10 years, which almost nobody foresaw at the time, combined with an increasingly chaotic and incomprehensible political situation. So what do I think is the link between those? Well, it's really in the title of the book that I wrote. Why did I call it Capitalism 4.0? My argument was that if we look back through the history of global capitalism as we understand it today, this really started in the mid-18th century. In fact, one could almost pinpoint it to a particular year, 1776, which was the year of two events simultaneously. At the theoretical level, it was when Adam Smith published The Wealth of Nations, and at the level of politics and political economy, it was the year of the American Declaration of Independence, creating the United States, which was the first, I would argue, self-consciously capitalist as opposed to feudal or pre-capitalist nation in the world. So this is a history of what now, 250 years or so. That history has been marked, I would say, by four dramatic crises, not just crises in global capitalism, but crises of global capitalism, which have punctuated four periods in which the world has been increasingly dominated by global capitalism, but it's been global capitalism in each of those periods of a very, very different type. So the four crises I was talking about, and I think are still highly relevant, starting from where we are today in 2008. The previous one was the inflationary crisis of the late 60s, from about 68 until the early 80s, which for those of us who remember was a period of even greater chaos and uncertainty about whether the world was really coming to pieces and falling apart. And funnily enough, now that we think about American politics, was also marked by the last serious attempt to impeach an American president, and culminated in that, if you like, with the resignation of Richard Nixon. But before that, there was an even more dramatic crisis, really from which in most people's memories was marked by 1929 and the Great Depression of the 1930s. But really, this was a collapse in the capitalist system that began with the First World War, 1914, or if you like, the Russian Revolution of 1917, which was a huge challenge, and didn't really stabilize again until after the Second World War. And the first crisis of global capitalism was the period from about 1848 onwards, the so-called Year of Revolutions, where you had revolutions all over Europe. It was the year in which Marx and Engels wrote the Communist Manifesto, and incidentally, it's really worth looking back on that because it could have been written today. It was an account of globalization, not just capitalism, but global capitalism and globalization, which is tearing apart all the traditional social relations and national feelings all over the world, and turning everybody, both the capitalist class and the proletarian class, into one homogeneous global whole. Exactly the kind of thing that the anti-globalists are arguing today. So you had these four crises, 1848, 1929, 1974, and 2008. At each of those points, it looked like the global capitalist system was finished, that it was dying, was destroyed. And yet, each of those times, the global capitalist system didn't cease to exist. In fact, it emerged stronger than before, but crucially, it emerged in a very, very different form. So before 1848, you had a kind of semi-feudal, it was the sort of pre-capitalism. After that, you had the liberal imperialist, nationalist capitalism of the Manchester School and free trade. That worked fine for about 60 or 70 years, but that collapsed, starting with the Russian Revolution and then culminating in the Great Depression. And what came out of that, what came out of the Great Depression, was clearly capitalism, the mixed economy capitalism of the war period and the post-war period, Keynesian economics and so on. It was still capitalist, was still marked by private ownership of property, competition, the profit motive, and so on and so forth, but it was almost unrecognizably different from what had gone before, the liberal capitalism of the pre-Russian Revolution period. That Keynesian capitalism worked extremely well. Again, it globalized the world economy, brought America and Europe together, and so on and so forth. But that also collapsed as a result of its own contradictions through the inflationary crisis of the late 1960s. And again, there was a period from about 1968 until the early 80s of complete confusion, chaos, riots in the streets, strikes, three-day weeks, and so on, and a sense that the system, that the world was falling apart. And yet again, capitalism didn't fall apart, but what emerged from that period in the early 80s with the Thatcher and Reagan revolutions was a form of capitalism completely different, again, almost unrecognizably different from the Keynesian mixed economy that went before. That also worked pretty well for 20, 30, 40 years, particularly worked well for Britain and even more so here in Ireland, as my brief introduction suggested. And that blew up, again, by virtue of its own contradictions in the 2008 financial crisis. As in the previous four phases, it was always likely that capitalism would survive, but it would have to be reinvented. And the process of reinvention is not just an economic one, but a political one and a theoretical one, which in each of these previous phases had taken 10, 15, or 20 years. I think we are now in the process, in the course of that reinvention. And what exactly, or what the new form will look like, is very hard to say, and I'm not going to spend time, maybe we can discuss it a bit in the Q&A, to try to discuss it. But I think the main issues and the main difference between each of these phases, and this will bring me on to where we are now in the world economy and what it may mean for financial markets, has been the relationship between the political and economic sphere, between government and free enterprise, between markets and one form or other of state intervention. And the way I look at it is in the first phase of capitalism, the two were completely separate. Politics and economics was completely separate. Government didn't get involved with economic or market decisions, except in very strict ways of raising enough taxes, basically to wage wars and protecting vested monopoly interests through protectionism in certain countries. That worked pretty well throughout that Manchester liberal imperialist period, but it fell apart starting with the Russian Revolution. What came after that was this Keynesian period when there was a sense that the markets had broken down completely and you needed to maximize government intervention because you couldn't trust the market, but you could trust the government. The market tended to be wrong, and the government was always right. And that actually also worked for 30 or 40 years, but then that blew up in the Great Inflation. What came out of the Great Inflation, if you think about it, with Thatcher and Reagan, was a view exactly the opposite of the previous one. The market is always right, and the government is always wrong. And that has actually also worked pretty well for about 20 or 30 years. What the crisis of 2007 and 8 really represented was the recognition that the market and the government can both be catastrophically wrong and often at the same time. This was a failure of both market and government. Now that may sound very, very despairing and hopeless, but I think what is emerging from that is an understanding that we are going to need in the next 20, 30, 40 years, a new relationship between market and government, between politics and economics, which is not adversarial in the way that it was both in the Keynesian period and in the Thatcherite period, but mutually supportive. How exactly that's going to work is what is now under really quite passionate and in some cases even violent debate. And it's not surprising that that process will take a long time. But I think what is becoming clear is that there are certain very, very important aspects of economic activity that are going to require and are beginning to receive much more public intervention through non-market mechanisms. first and foremost, management of the macroeconomy, with monetary and fiscal policy again becoming much more actively engaged in stabilizing the economic cycle than they were in the 80s and 90s. To that extent, you could say we are seeing a reversion to the 50s and 60s, where it was a government and central bank responsibility not just to control inflation, but to ensure that unemployment and economic activity continued along a smooth path. But in addition to that, you have a recognition that there's need for much more detailed financial regulation. That, I think, is something that has actually already largely happened, incidentally, to the great benefit of Ireland and cities and the city of Dublin, which has become a great center of this. But I think much more importantly than that, there's now also a recognition that there are public goods, and very, very important public goods such as the environment, which cannot be provided by the market, and in which politics and government are going to have to get much more involved. And decisions will have to be made, as they are in politics, on the basis of one person, one vote, rather than, as they are in economics, on the basis of £1 or €1 or $1 a vote. It's this tension between €1, one vote, and one person, one vote, that I think marks each of these transitions. So what is the relevance of all this to what's going on today? And this is where I'll move on to the medium term and the shorter term outlook for the markets. I think where we are today is, as we said earlier, an unprecedented situation in monetary policy. Negative interest rates, the European Central Bank has returned to buying bonds, quantitative easing, and so on and so forth. And a situation in which it appears that if you look at the way that the central banks are behaving and the bond market is behaving, the world is still in a period of great uncertainty and even crisis. It's unsustainable, and certainly something we've never seen before. On the other hand, you look at the way that the equity markets are behaving, a new all-time high, I think certainly on Friday, probably today again on Wall Street, even outside Wall Street in Europe, stock markets back to their highest levels since the beginning of the financial crisis, and also in the business community, record levels of profitability, pretty strong hiring, not strong productivity, but strong employment growth in pretty much increasingly large part of both the developed and the developing world. So there seems to be a contradiction between what the equity markets are saying and what the bond markets and central bankers are saying. They can't both be right. And I think one of the reasons that there was such a panic in financial markets as recently as this summer, when stock markets were collapsing, bond yields went down to negative levels. I'm not sure if they ever did in Ireland. Did the Irish bonds are they still at negative levels? No, but certainly, 70%, something like $17 trillion worth, or euros worth, of bonds around the world were actually paying negative interest rates, like those mortgage lenders in Sweden, Denmark, as recently as 2 months ago. One of the, and I think perhaps one of the most important underlying reasons for that uncertainty and anxiety was that there seemed to be this complete contradiction between the way that the equity markets were behaving and bond markets were behaving. And there was a sense that they couldn't both be right. How could you simultaneously have equity markets at or near all-time highs and bond yields at zero or negative levels? The bond yields seem to imply that the world is on the brink of recession and or in the midst of a long-term, of a generational secular stagnation that is going to go on not just for years but for decades. Meanwhile, the equity markets were behaving as if everything is fine, growth will continue, and there's not much risk at all in the years ahead. And the perception of most commentators, and particularly economic commentators, was that if there's a contradiction between stock markets and bond markets, the bond markets are likely to be right. Because after all, the bond markets are inhabited by analysts, many of whom have PhDs in economics and work for central banks or the IMF, whereas the equity markets are basically inhabited by hucksters, salesmen, good news merchants. We know who to believe. But in fact, I don't think this contradiction exists. I think that actually what the bond markets and the equity markets have been saying is consistent, because they're not giving opposite answers to the same question, namely, is the world economy okay, or is it on the brink of a recession or depression? That's the common perception. Instead, they're answering two different questions, and actually it turns out that their answers are consistent, in fact, mutually reinforcing rather than contradictory. What do I mean by that? The question that the equity market is answering is, what has happened to real economic activity around the world in the 10 years since the financial crisis, and what is likely to happen in the 2, 3, 4 years ahead? And the answer to that, surprisingly, is real economic activity, if you measure it in GDP, in incomes per head, in real incomes, has actually been, for the world as a whole, in the last 10 years since the crisis, just as strong as it was in the 30 years before the crisis. The average rate of growth in the 30 years of 1977 to 2007 of the world economy was 3.6%. In the last 10 years, the global rate of growth, and indeed in Ireland as well, since your crisis, which was 3 years later, the rate of growth in those 10 years has never been below 3.2% until this year, or above 3.8%. It's been exactly on that 3.6% average. So in fact, the world has performed in real terms much as it did before the crisis. In that sense, the whole idea of secular stagnation, which is very much discussed by bond markets and central bankers, is a myth. And this is not forecast, this is fact, this is statistics. The reason for that is that although every single part of the world economy has slowed down since the financial crisis, including America, Europe, Japan, even China, the effect of China and Asia and the rest of the emerging markets just growing, raising that base so much, has more than made up for the slowdown even within China. If you think about it like this, that sounds paradoxical. What do I mean? China today is growing by 6% from a base of $12 trillion. Before the crisis, it was growing by 12%, apparently twice as much, but from a base of only $3 trillion. So you just do the arithmetic and you find that actually 6% growth in China today is actually faster from the point of view of the world economy than when it was growing by 12, 14, 15% in the decades before the crisis. Now, this isn't just some kind of statistical trick. This is what's really relevant to equity markets and actually to other assets that are exposed to what is going on to incomes in the world economy. For example, property prices in global financial centers like Singapore or London, or perhaps even right here in Dublin. It's not surprising that all these asset prices have been going up rapidly, despite the apparently crisis conditions that exist in the, that seem to be implied by the bond markets and the central bankers. So that's the answer that the equity market has been saying. That's been saying, look, if you're a global company, whether you're in oil or in iron ore, but also in manufacturing, making cars, making telephones, or even in luxury goods, you're exposed to the whole world market, and it's just as good for you if you've got $100 billion of growth coming from China as $100 billion of growth coming from Europe or America. In fact, it's arguably better. If you're in luxury goods, for example, I was giving a similar speech in China a few months ago, and I said, somebody in my, I run a reasonably profitable company, and yet I have this watch which is worth 15 euros, and I replace it every few years. If I were in China, in the similar position, I would probably have a watch worth 1,500 euros. And somebody put their hand up and said, no, you're completely wrong. Your watch would be worth 15,000 euros. And that, so for a company, that makes Swiss watches or LVMH or something, this growth is fine. So that's the answer the equity market is answering, and as long as that growth continues at 3.5% for the world economy as a whole, there's nothing, I think, particularly risky about equities where they are today. So how do we explain what's going on in bonds and this angst and anxiety among central banks? Well, the question that the bond market and central banks are answering is completely different from the one about world growth. What they're answering is the question of what has happened to inflation and to the long-term structure of interest rates since the financial crisis. And while real economic activity has not changed at all globally since the financial crisis, the structure of interest rates and particularly inflation has changed dramatically, and it seems permanently. since the financial crisis. We're now in a world where all over the world, inflation is between 1%, and even in the more inflationary developing countries like Brazil, where I just came back from on Friday, it's running at 4 or 5% instead of double digits. And not only has inflation come down, but there is now a conviction that this is not just a temporary aberration caused by the depth of the financial crisis, but we're in permanently low inflation conditions in a completely different interest environment. Because the central bankers no longer, they no longer believe that inflation is coming back. They may be right or wrong, but they've made it very, very clear, especially this year, since the US Federal Reserve did its U-turn in December, January last year. They've made it very clear that they no longer are going to worry about inflation. They may turn out to be wrong about this, which is my last point, which I'm about to come to. But the fact is that they believe that they're not going to, they are saying, and they're making it very clear through their actions, that they're not going to worry about inflation coming back, even if the world economy continues at a growth rate of 3.5%, 4%, seems to be coming up against its full employment limits, and so on and so forth. They are not going to tighten monetary policy, because they now perceive their job to be completely different from the way that it was in the 80s and 90s. In the 80s and 90s, the job of central bankers was to get inflation down, keep it down, and make sure it never rises again from the dead, put a stake through its heart. In order to do that, the central banks, led by the Fed, but followed by every other central bank around the world, had to keep interest rates positive in real terms. In other words, higher than the rate of inflation, all the time, throughout the economic cycle, except for very brief periods during deep recessions when they'd cut the rate, but as soon as the economy recovered, they'd raise the interest rate again to positive in real terms. We can now see with hindsight, and I must say that I saw this even 8 or 9 years ago, that the job description of central banks completely changed in 2008-9 as a result of the financial crisis. And it didn't just change a bit, it actually reversed. It became the opposite. The job description of central banks for the last 10 years has been, we've got to get inflation up, keep it up, and make sure that it never falls again to the point where it threatens the stability of the world financial system. In order to do that, the mechanism for doing that is to keep interest rates negative in real terms throughout the financial crisis, throughout the economic cycle, except for brief periods where you're so convinced that the economy is really strong, and then you briefly put them up into positive in real terms, which is what the US did last year. But the moment there's any sign of a slowdown, you cut them again. And this is what happened. The Fed did it first, then the European Central Bank went even deeper into negative interest rates because inflation is so low, and QE, and we see this now happening around the world. The Bank of England last week was the last one to throw in the towel and say, we are not going to raise interest rates, even if Brexit goes away, even though our economy is at full employment, inflation is up near our 2% target, it may go above. We will tolerate that because the risk of low inflation is much lower. And so what we have is a situation where the bond markets are saying, we don't care about the real economic activity. We care that inflation and interest rates are permanently down, at least permanently on the time horizon that's relevant to markets, which is about 2, 3, 4 years ahead. And during that period, we are simply going to follow what the Fed central banks are doing and saying, and that is interest rates at 0 or negative. As a result, bond yields are very low. This is not contradicting the story from equities. This is actually reinforcing it. Because we have a situation today in which the bond markets and the central bankers feel that we're in a world of secular stagnation. Therefore, they have to throw more and more money into the world economy. But from the point of view of the real business community and the equity investors, there is no secular stagnation. We're still growing at 3%. We're growing at 3% as a result of the efforts of the central bankers and the bond markets, but far from making the world economy less stable, that's actually making it more stable and the value of these equities higher because they're comparing, what may be still a very modest return, 3%, 4% yield on equities with a yield of 0 or negative on bonds. So actually, in my view, there is no contradiction between bonds and equities. They're mutually reinforcing. So that's the good news. Now, finally, Well, what's the bad news? Well, the bad news, of course, is this is I think, a very accurate description of what's happened over the last 10 years. How long can it go on? Can this situation go on for more than another few months? This summer, there was a period of panic when the financial markets and many economic and financial commentators said, okay, well, this period was fine for the last 10 years, but it's now come to an end. And it's come to an end as a result of, I would say, this was the reasons for the concern threefold. First of all, the negative yields in the bond markets on their own seem to be a signal, a wrong signal, as I explained in my view, but a signal that something was badly wrong with the world economy. Secondly, the US-China trade war seemed to pose a serious risk to what were the two strongest economies in the world, America and China, that either one or both of them would fall into recession and drag the rest of the world economy with it. And thirdly, and this sounds like a very naive and silly reason, but going to America, talking to clients, I found it surprisingly widespread, that this summer was the 10th anniversary of the economic expansion beginning in the United States. The longest economic expansion the United States has ever experienced in its history without a recession was 10 years. And the 10th anniversary was June this year. And there was a surprising number of analysts and investors and economists even, sort of theoretical economists even, who said, well, from now on, from June onwards, a recession is overdue because this has never happened before. So those three reasons, there was this concern in the summer that the world is about to tip into recession. That concern has now turned out, I think, pretty clearly to be wrong, at least for the time being. As I said, the negative yields on their own didn't say anything at all about growth. All they said was that now there's a conviction and a confidence that inflation is coming back. The 10 years of economic expansion, this deadline, once it passed by July and August and became clear that there wasn't suddenly going to be a sort of time limit coming down, that idea has gone away. Nobody's worried about that. And incidentally, that was always a very silly idea because there's no evidence that economic expansions die of old age. And while it's true that in the US, these cycles have never gone on for longer than 10 years, in the UK, for example, we had an economic expansion from 1982 to 2007, 15 years. In Australia, they're now in the 29th year of an uninterrupted economic expansion. So that's gone away. And then there was the remaining argument, which I think was the only substantive one, which is about the US and China. And this is my last point, which everything I've said so far has really been about the past, and therefore I'm really reasonably confident about it. And this is the last point, which I'll make very brief, which is going to be a prediction about what may or may not happen in the next year or two. Now, the US-China trade war has been and will continue to be a very disruptive, possibly the most disruptive in the medium-term influence on the world economy. That is a fact, and I think that's not going to be reversed by any kind of deal that may or may not be announced in a few weeks' time between Trump and Xi on a few tariffs and things, because there is a fundamental clash, which we may well discuss in the panel, between the long-term evolution of China as the world's largest economy and it overtaking the United States, and the unwillingness of Americans to accept that their country could ever be even rivaled or matched, never mind overtaken by another part of the world. So that's going to still be there, and that's a fact. But somewhat surprisingly, perhaps, the impact of that US-China trade war on the two countries concerned, on America and China, has turned out to be very different from what people expected and what is even now perceived. It's still perceived, even today, that either America or China are bound to have suffered from that, and if not gone full scale into recession, at least slowed down very dramatically as that trade war has escalated. The fact is that when we look at the data that has now come out for 2019, for both America and China, their economies have performed exactly in line with predictions that were made by the IMF, the OECD, and practically every reputable forecaster over a year ago in October 2018, before the trade war really escalated and before the peace talks broke down in April this year. The impact on the aggregate growth of the US and China has been zero this year. The world economy, though, has suffered. And the part of the world economy that has actually suffered over the last 12 months, largely as a result of the US-China trade war, ironically has been what should have been or might have been the innocent bystander, and that's right here in Europe. If you look at the data that has come in over the last 12 months, overwhelmingly the weakest part of the world economy, and the only one that has really surprised on the downside has been Europe, leaving aside Brazil and Argentina, a few places with localized political shocks. Europe has performed disastrously in the last 12 months. And that has been partly a consequence of the US-China trade war, because Europe, the Eurozone, and Germany in particular, are much more exposed to world trade than either America or China. But on top of that, and I think more importantly than that, when America and China were hit by the shock or potential shock of the trade war, both of them responded by compensating for that shock with stimulative, what we call in economics, counter-cyclical policies. The Fed stopped raising interest rates and started cutting interest rates. The Chinese eased their credit conditions, eased their monetary policy, started spending money on infrastructure and so on. They both acted to stimulate or at least to support their economies. In Europe, the story of Europe, as you know very well in Ireland, possibly better than anywhere, the story in Europe has been European policymakers have responded to shocks, usually with pro-cyclical economic policies, which have made those shocks worse rather than better. And that was the expectation for much of the summer. And that's why, if you look at what happened for bond yields, for example, over the summer, they fell all over the world. But in the US, they fell from the top to the bottom of a trading range that had actually prevailed for the last 8 years, since 2011. They fell from 3% to 1.5%. But they never broke through that 1.5% level and have now bounced back up. In Europe, on the other hand, the bond yields collapsed to these deeply negative, crazy levels, way below anything that had ever been seen before, even at the low point in 2016. That, I think, reflected the market's judgment that it was Europe that was at greatest risk of moving into recession and possibly dragging the whole world down into recession and secular stagnation with it. So that's the bad news. The good news, and this is what I'm going to end on, which is why I'm actually relatively optimistic about risk assets and financial markets for the next year at least, and possibly probably for the next 2 years. The good news is that for the first time since the financial crisis, and arguably really since the creation of the euro in 1999, there are some signs that the policy response in the Eurozone is turning out not to be perverse in the way that was widely expected, but at least to be modestly supportive. And I think the turning point really came with 3 political events, all of which occurred within the last 3 months. The obvious one was the ECB resuming the process of quantitative easing, saying we will buy up all the bonds that are issued by all the Eurozone governments. What that has done is both eased monetary conditions, especially in the periphery countries. It hasn't helped Germany very much because they've already got negative interest rates, and that's probably harming them, probably Ireland the same. But for Italy, for Spain, for Portugal, even for France, reducing the spreads between Germany and the rest of Europe has stimulated monetary policy. Even more importantly, it's had a fiscal effect, because by reducing those interest rates to countries like Italy from 1.5%, 2% to essentially near zero, what Draghi did was created a significant amount of additional headroom for them to cut taxes, increase public spending without violating the European fiscal rules. Italy right now, even with present low interest rates, is still spending 3.5% of GDP on interest payments because of the size of their debt. If interest rates remain at or around the current levels, in 5 years' time, it will only be spending 1.5% of GDP on interest payments. That additional 2% of GDP is now becoming available for fiscal easing in Italy, in Portugal, in Spain, and also in France. So that's the first, that's the big change that occurred, and I think markets are beginning to buy into this. The second change that occurred was the change in European politics with the European election, and I think particularly with what happened in Italy, the idea that there's going to be a sort of populist tide which will threaten the euro with a politically led breakdown rather than financially led breakdown was a very, very big and legitimate cause for concern for markets all over Europe, and that has essentially disappeared now. And the third one, actually I said I wouldn't mention Brexit again, but I will now right at the end. The third is literally what's happened in the last month or so with the removal of the no-deal Brexit threat, which was always going to be a very, very serious risk for Britain and Ireland, but was also a significant risk for Europe as a whole. Britain is the second largest trading partner of the Eurozone. The UK is twice as important as China as an export market for the Eurozone as a whole, 12% of exports instead of 7% of exports. And the risk that there would be a sudden stop as a result of no-deal Brexit, with no transition period, no new relationship, no treaty-based, no reliable mechanism for resolving trade disputes and so on, and that this would suddenly happen overnight on October the 31st, did raise the possibility of a 2008-style crisis, at least for Europe and Britain, if not for the world. That has now been removed. So when we combine the removal of these political risks of populist politics and Brexit with the improvement of financial and monetary and fiscal conditions in Europe, I think there's a decent chance that Europe in the next year is going to outperform expectations, will do better than expectations, rather than what it's done for the last 18 months, which is deeply underperform expectations. If that is the case, given that the US and China have not really suffered from the trade war because they've implemented these supportive policies, it's quite likely, and I think it's more likely, considerably more likely than not, that 2020 will actually be a stronger year than 2019, and it's almost certain that there will be no recession or serious slowdown in the world economy between now and the end of next year, which I think creates a reasonably conducive environment for risk assets. Okay, I'll stop there. I think I've kept to 40 minutes, so that's fine. All right, thank you very much.
Well, thank you, Anatole, for those really insightful remarks. You mentioned that some people in Denmark are actually getting paid to take out mortgages.
So I'm told.
Well, some might argue that's an unhealthy sign of a financial system. As a man who's looking for a mortgage in the next few years, I wouldn't be too devastated if it did come to Ireland. My name is Alex Cooney. I'm a portfolio manager at Santiago Investment Advisors. And we're now going to move on to the second half of the evening, which is our panel discussion with Anatole and with the SIA Advisory Board. Before I introduce those that have just joined the stage, I wanted to say there will be an opportunity for audience members to ask questions, that we're going to do it after Graham's closing remarks, just so people who need to leave at 8:30 have a chance to do so. And now, to our expert panel. Sitting next to Ronan at the far end of the stage, we have Bernard McAlinden. Bernard is an investment strategist and is currently strategy coordinator for the European Securities Networks. Helen Thomas is founder of the influential consultancy, Blonde Money, and was previously advisor to the Chancellor of the Exchequer, George Osborne. And Dan McLaughlin. Dan is an economic expert and was formerly chief economist at Bank of Ireland. And Dan, my first question is to you. So Anatole mentioned the historically low level of interest rates we're currently living through, and many of our audience will be getting close to 0% on any savings in the bank. Is this likely to change anytime soon?
I would distinguish, though, between negative rates and low rates, because I think the perception for central banks was that there isn't much difference between an interest rate of 1% and an interest rate, say, of minus 0.5%. But I think the evidence suggests there is a massive difference. And I think if you look across the world, there's only, people talk about negative rates, but if you think where they are, you have the ECB, you have marginally negative rates in Japan, you have Switzerland, you have Denmark and Sweden, and that's it. And if you look at bond yields are not negative in markets where the central bank has not gone negative with its rates. So Anatole mentioned United States. I mean, you've got it was 1.5%. Rates have risen quite significantly, actually, in the last few weeks. So I think there are a lot of places where you can still get a positive interest rate on your bonds. So I think the ECB made a massive policy error. I think it's helped to destroy the banking system, is maybe overstating it, but severely hammered the banking system and severely damaged the pension and insurance industry as well. And I think it was quite noticeable that after the recent ECB rate reduction, it became clear, and in fact very unusual, in fact uniquely so, that a number of members of the governing council came out very clearly and thought it was the wrong thing to do. So I'd be much more negative about the Eurozone for that reason. I can't see how they're going to get out of this now, because in my view, negative rates are hitting the banking sector. And I also think that they're sending a message. They're sending a message to people saying, my God, interest rates are negative. So instead of cutting saving, people are saving more, I believe, on the back of it. So I think you can still get positive yields in other currencies. You've got to take currency risk.
Sure.
But I wouldn't necessarily say that everything is it's all to do with negative rates. And just one final point. What's very interesting to me is in the last few weeks we've had a very significant change in rate expectations. If you look right now, even in the Eurozone, 3-month money is minus 0.4%. If you look at the futures market, it's not even pricing in another rate cut fully. And the return to positive rates was expected to be the end of 2025. It's now in the summer of 2024, and that's a long way away. But I think also if you look at the United States, the market was looking for the Fed to cut rates to 1% at the bottom of this cycle. That's completely gone. They're not even fully pricing in any more rate cuts. So I suspect that we won't be seeing negative rates anywhere else. I think it's very clear the Bank of England will not go negative, nor will the Fed. So rates are very low, but I don't think other people will follow into negative territory.
Okay. Ronan, rates very low. What are SIA saying to clients who might have traditionally gone into a balanced portfolio where maybe 40% of their portfolio or something like that would have been in bonds? What are we saying to clients?
Well, we get asked quite often, or there has been a drive in the more recent past with regulation going to ESMA 2 type portfolios, low risk portfolios that might have 80%, 70% in bonds. So we get asked quite often, so what is a low risk portfolio in 2019? And it's kind of it's a fascinating question because it kind of divides people down the middle. And you can get some older guys, a lot older than anybody on the panel here, who would be equity people and sort of say the only low risk portfolio in 2019 are equity portfolios, which are generating dividend yields of maybe 3-4%. Now that obviously poses an awful lot of difficulties for people because we know if we take a measure of risk as volatility, how much it does this, a lot of people can't do that. So it does pose us a major difficulty. But there are emerging market dollar bonds, for example, will pay 4.5%. We have recently started to put some clients into Chinese onshore renminbi bonds with a yield to maturity, again, 4%. Now we have to do that through a fund, okay? The others we will buy through an exchange traded fund. But emerging market dollar bonds at 4.5%, where arguably there is a more orthodox economic policy and monetary policy going on. But we'll probably come to it. We'll probably come to it later on. But there are with the growth of exchange traded funds, and I know otherwise they're known as ETFs, and I'm going to go into something slightly different now for 1 second. Traditionally, exchange-traded funds morphed or replicated an index as set up by Jack Bogle of Vanguard, but as time has moved on, they've become into what we call smart beta. So, in other words, ETFs that track specific things. And some of the more attractive exchange-traded funds, one we'll use a fair bit, is the Global Quality Income, which is designed just to track and pay dividend yields of 4%. But I do think you are having to push people into the equity asset class or the emerging market dollar bond asset class, where there is a lot of hand-holding to be had or to be done.
Okay. Helen, for the best part of the past 10 years, as Anatole mentioned, it's been the US market that's been fueling this kind of rising global stock market, with the result that it now looks quite expensive relative to Europe and indeed the rest of the world on a valuation basis. Now, Anatole made the case for Europe to outperform over the next kind of 12 to 18 months. How are you thinking about the valuations of the US market versus the rest of the world?
Yes, well, you've heard both sides of this already, haven't you, with our two speakers here on optimism or pessimism when it comes to Europe. I think, look, the work I do is all about unpriced risk. It focuses a lot on politics and political risk, and absolutely, I think when it comes to Europe and the US, therefore, in the next 12 months, we do have to look at the political side of this, which is, of course, it's election year. And we've already seen with the pact on the raising of the debt ceiling between the Republicans and the Democrats in the US is that, nobody wants to squeeze things going into that election year. So, look, there's an awful lot of tailwinds coming into the US economy. I would imagine just keep on trucking. And then on the other side of that, you've got almost Faustian pact with the Federal Reserve, where they've done their about turn, and they're keep on trucking with the cuts if they need to, and it sort of adds up to again a sort of positive sentiment. So then when I look at the Eurozone, really there's quite an unknown quantity, because there's one new person involved, and that's Madame Lagarde. And what she may do at the European Central Bank, of course. And in a way, from a very political background, I think she could become quite an important figurehead. In fact, I'm very much looking forward to the Trump tweets and whatever nickname he gives to Christine, either Pocahontas for Warren. I mean, God knows what Christine's going to end up being called. But I think that will be significant, because it's that question of, you've heard already tonight, is there a fiscal stimulus effect coming from the low interest rates, or are the low interest rates binding the banks into a sort of deadly deflationary trap somehow? I personally, because of the trade war tension, would err on the side of pessimism. But in that sense, therefore, I would say that that US outperformance could continue, at least for the next 12 months.
Okay, and you mentioned the cuts that the Federal Reserve has made this year. Bernard, what do you make of the current relationship between the President, Mr. Trump, and the supposedly independent central bank and the Federal Reserve? Are they caving to Trump's pressure?
Well, Trump has certainly gone beyond the norm in terms of politicians putting pressure on central banks, but it's not unusual. They do it coming up to elections anyway. Trump does everything more aggressively and differently. But it's a dangerous thing if politicians can never get inside a central bank for reasons. Now, we haven't had inflation for a long time. We know that. It doesn't mean you won't be in a situation in the future when you need a central bank to do the real job of a central bank, which is making sure that the money supply growth doesn't accommodate inflation. In other words, doesn't grow faster than the economy. So central banks have to be independent. So it's always a worrying thing when you see a politician go further. But really, I think the Fed hasn't cut any more than you could actually justify, because this trade war is really what's weakening it's the most identifiable thing for what's weakened the economy, as has been said. I don't think the Fed has gone beyond what's necessary. They could even do another cut, and you couldn't accuse them of being political. But it's a dangerous thing in principle, but I don't think anything has changed yet.
Okay, so a dangerous game.
Yeah, it's in principle it's a dangerous thing, but I don't think you're actually seeing evidence that the Fed has been influenced.
Dan, you wanted to make a comment on that?
No, just a general comment about the outperformance of the US, which has been going on for a while now in equity markets, and I think there's been significant structural changes in some industries, and it's easy to see now looking back. So, for example, we had a massive change in, retailing, and one company dominated that change, which was Amazon. We got a massive change in the way people were viewing content, entertainment. So that's Netflix. We got a massive change in the way people access advertising, Google. So what I'm saying really is that the reason United States outperformed, I think, largely was because they had, we'll call them the FANGs, but they accounted for a huge proportion of that outperformance. And American companies dominate in those kind of areas. There are no exciting, dynamic European IT companies, I don't think. So maybe that's not accidental either. So I think the reasons the United States outperformed more to do with that kind of stock-specific kind of issues rather than...
So really driven by these FANG stocks that have been carrying
the
headlines.
So to me, the interesting question now, and I was talking to this with Ronan recently, is that is that over? I mean, there are challenges for a number of them, Netflix, for example. So are you going to see now a return to some more traditional value stocks that do well, that have been maybe they're catching up a little bit in the last few months, but they've lagged for a long time. And the whole ETF approach also, of course, means that some value stocks just get left behind.
What do you make of that, Anatole, on the industry structure? It just doesn't seem like Europe can produce tech champions like the States can. We don't have an Amazon, we don't have an Apple.
No, that's true, but thank you very much for bringing me in here, because I wanted to make a few comments, actually, which it may sound like much of what you've heard has been the opposite of what I was saying, but actually I agree with quite a number of the comments made. So specifically on this question of US performance relative to the rest of the world, I think that what Dan was, I think, implying, and I would like to emphasize it, is that the stock market performance, relative stock market performance, does not depend on how different economies perform in absolute terms, but to the extent that it's related to economic performance, it's how they perform in relation to the expectations that are already built into prices. Now, the reason I'm relatively optimistic about Europe, I mean, I completely agree with Helen that Europe is not going to suddenly leapfrog the United States, overtake it, either in terms of growth or in terms of creating these kind of businesses that Dan was talking about. But nevertheless, I think in stock market terms, it could well, and in currencies as well, Europe could perform better than the US, I think, for the next year or two, simply because the expectations about Europe that are built in are now so low. In August, this year, so 4 months ago, German investors were asked in the so-called ZEW survey what their expectations about the German stock market were for the next 6 months. And the number hit an all-time low in the 40-year history of the survey, but more significantly, it was about 20% lower than the worst point of the 2008 financial crisis, and far lower than it was in the Euro crisis, which of course didn't really affect Germany, but certainly affected countries like this one. So the expectations about Europe are extremely low, and that it at least creates the possibility of this rotation towards value. Now, the other thing that I think Dan was also mentioning is that a number of the companies that have led the American economic and financial expansion are now moving into a different phase of their corporate life. They're moving from being innovators in the vanguard of technology and business disruption into being essentially monopolies and monetizers of monopoly profits. Now, in that situation, of course, monopolies can be very, very profitable, more profitable than any other businesses, but they're also subject to a great deal of political risk. I would say not just risk, but a certainty that at some point, maybe not this year, maybe not even 3 years' time, but a certainty that companies like Facebook, Google, probably also Amazon, are going to be regulated out of existence in their current monopolistic corporate forms. And that also means that there is a potential for a shift in relative stock market performance, which is kind of distinct from the relative performance of the two economies, where I completely agree with Helen. The US is actually going to get quite a strong tailwind over the next year, both from the interest rate cuts and probably from some increased public spending and maybe even tax cuts before the election.
Okay, so positive in Europe, not necessarily because of a huge transformation, but just because
it's not as bad as it
are so
seems.
low.
Yeah.
Interesting. And I want to bring Bernard back in. So Ronan mentioned emerging markets earlier in our conversation. What's your perspective on emerging markets at the moment?
Well, emerging markets, as Anatole has shown us, really, that's where the growth that's compensated to keep the world growth up at its 30-year average or whatever has been coming from. That's the part that's getting better off. That's the part where people are GDP per capita rising. So when this is going on, the counterpart of that is they should be getting politically more stable as we get politically less stable. Now, governance is everything. It also depends on what kind of political regimes and governance you have. But there's risks everywhere on that. And lots of these emerging markets have regimes and governance that's improving. And is not that different. It'll never be the exact same as the Anglo-Saxon model, which isn't perfect anyway. But certainly, if you're looking at a diversified portfolio, and you see that that's where the growth is coming from, that's where things should be getting politically more stable. Increasingly, part of a portfolio, not a huge part, but a significant part, goes that way.
Well, that's interesting, because I think it's commonly perceived that emerging markets are more risky. And they certainly can be in a political sense, but if it's where the growth is going to come to in the future, that seems to be a bit different.
Yeah, and wherever we don't live is always to some extent more risky to us, but they're not as risky to people in emerging markets, so we have to put ourselves in the other position too. But there is risk there because they're less tested than, say, the US market over a much longer period. And the US market is constantly the dearest market in the world. The issue at the moment is it's historically dear relative to Europe, but it's always dearer. And if you look back over history, it's always been worth being a lot dearer because they do develop the new industries. It's not just the FANGs. You go back the previous generation, you had the Microsoft, Intel type thing that led on to the FANGs, so you had the hardware type thing. But you go before that, for all we could say about the US economy, still it produces the new industries, and technology is always moving on. And okay, I fully agree that regulation is coming for these monopolies. They've been incredibly successful. But you create a monopoly, you will have a long time as a monopoly before the pressure will be there. So what's the new industry that'll be the new monopoly? The betting is they'll come out of the US again. Europe has been incredibly bad here. The Chinese at least copied the FANGs and made sure they had their own, whereas Europe has nothing. All the lunches that are being eaten by the disruptors, the disruptees are in Europe. So you can see, how the valuation of a stock market structurally is dictated by these things.
I want to bring things a bit closer to home and ask Helen about this upcoming election we have in the UK. So we have the Conservatives and we have Labour both promising to spend billions as part of their campaign pledges. What are your thoughts on the election? Yeah,
it's quite amazing. As you outed me earlier for having worked with Mr. Osborne, and that was in the run-up to that 2010 election.
Should I get my mouth shut?
It feels so many years ago now, so many elections we've had since then. But I think it actually ties in a lot of what we've talked about tonight, which is, of course, back then, I'm sure we all remember, I think it was 2010 election where Bill Gross said gilts were sitting on a bed of nitroglycerin. And of course we had the European sovereign debt crisis. Of course it was all about getting your house in order. Totally different world that we live in now. As you've said, what we're seeing frankly, from the Labour Party and Conservative Party going into this election is the checkbooks are out. It's just a question of what eye-watering amount of money you want to put onto it, which is quite amazing. But of course, the world has completely changed. And one thing we haven't mentioned, and maybe Anatole might mention, I'd like to hear your thoughts on it, is those three letters MMT. And this idea that, the bond vigilantes are now dead. It used to be there's that famous remark about I want to come back as the bond market because it bullies everybody into submission. Well, now, with zero interest rates, zero as far as the eye can see, it doesn't matter how much you spend, and there is no inflation. And therefore, this economic and political clash that Anatole was talking about is now kind of feeding off one another into a very, very different world. And so, despite some optimism for the next 12 months, what I'm really concerned about is if inflation did come back in some way, after we've had these rate cuts, the stimulus and the fiscal stimulus and the political crisis that has meant everybody now has to get the checkbooks out, where on earth are we going to be in a few years' time when that happens? So, sorry, you asked me specifically about this election. I mean, look, I think it is relatively significant today that Nigel Farage has obviously said that they're only going to stand seats they're going to stand down from seats the Conservatives won in the last election, which should help Boris to a degree. I mean, he wouldn't have got to this point if he didn't think he was going to win a majority. Probably will maybe get 20, 30 seats, maybe 50 in a really good scenario. But, it's 4 weeks to go and events, dear boy, events. Who knows what could happen. But in some ways, I think it's a charade. It's like a sideshow to a much bigger question. What is Britain's relationship with Europe going forward? We have, much more to discuss on that future trade arrangement. And then, as I say, this much more significant point about how are our economies run?
Okay. Well, Helen, you mentioned MMT.
Helen mentioned MMT there, sometimes known as magic money tree, but more specifically called modern monetary theory. And it briefly it states that if a country has its own currency, it can pretty much fund as big a deficit as it wants. And the way these things often work is there's a kind of an academic paper by some of the feds, and it's floated out there, and it it gains traction and it gains credibility. And on the surface, it might sound madness, but I suspect if many of you haven't heard of it before, you can mark the date down as being you heard it first here. And I actually think, and we'll just go on, it echoes very much, which I don't quite understand why this happened, to when Jeremy Corbyn became leader of the Labour Party, his People's QE. So to me, People's QE and MMT are very, very similar. But it is something that we need to consider.
Anatole, what's your take on this magic money tree?
Yeah, well, I'd love to comment briefly on both the magic money tree and the British election, and they're linked. So on the MMT, I will elaborate a bit on the last point Ronan made, which is that this is another variation on the idea of printing money and putting it straight into the economy instead of doing what the central banks have done for the last 10 years, which is printing money and trying to get it into the economy through the bond market. And I think it is an idea whose time has come, and I'm not as pessimistic about it as Helen is. It is true that if we get into a situation of accelerating inflation, then this would be pouring more fuel onto the fire. But we're not in that situation, and I think if we do get into the situation of higher inflation, it's not going to happen. What the circumstances in which this fiscal monetary spending, printing money and giving it directly to the people in the economy, the circumstances in which it could happen will be one in which inflation remains very low and growth collapses for one reason or another, because of the US-China trade war or something, or stock market crash or whatever. And there is this perception out there that, well, when the next recession hits, it's really going to be the big one. It'll make the 2008 thing look like a picnic because there won't be any mechanism to respond to it because interest rates are already at zero. I completely agree with Dan that negative interest rates are not working. They're proving counterproductive. Where I'm not sure I agree with him is I think QE is working. I think the ECB buying up bonds and financing the governments is working, but negative interest rates isn't. So what on earth can be done? But the answer is, and this may be part of, the answer to my question is what's the fourth generation of capitalism going to look like? The answer is that actually governments can and I think will be financed by central banks to spend larger amounts of money than ever before, not necessarily, and I hope not, on wasteful government spending projects, but on simply giving the money out to the people, to the private sector, and then allowing citizens to make the decisions about how that excess money is to be spent. Now, I think a very interesting straw in the wind on this is that it's, MMT and even sounds, modern monetary theory sounds really obscure and boring. Magic money tree sounds fantastical and nursery rhymish. But another way of describing this phenomenon is called helicopter money, which was an idea that actually Milton Friedman, of all people, first proposed. And he said that in extreme situations like the one that we might face in the next recession, there's always a solution that the central bank can undertake, which is hire a helicopter, fill it up with money, and drop the money on the cities of the nation. And interestingly enough, the idea of helicopter money was proposed this summer, and this is a straw in the wind, not by Jeremy Corbyn or Donald Trump or any sort of crazy politicians, but by two of the most respected and conservative central bankers in the world in a paper that was published, you probably saw it, Helen, by BlackRock, the former head president of the Swiss National Bank, of all things, Philip Hildebrand, and the former deputy governor or deputy head of the Fed and also of the IMF, Stanley Fischer. And what they said is, in the next recession, if inflation hasn't picked up, if it has picked up, then fine, there's no problem. If it hasn't picked up, we, the central bankers, are going to be faced with the inevitability of issuing money directly into the economy through helicopter money. And it's our responsibility, if we're prudent central bankers, to start planning for this now and come up with a mechanism that will do this in a responsible, adequate, but not excessive and politically accountable way. Let's do it now. Let's start talking about it now, rather than pretending that this is not going to happen and then being faced with an emergency and do proportion. So I think it is an idea whose time has come.
Dan, these seem like slightly radical policies. What are your thoughts on all this?
Just on the fiscal policy thing, Anatole made a dichotomy between, if you like, the real economy, of late and inflation. And I think that's an interesting way to look at it, because what I find odd is if you look at the UK economy, by most standards, it's at full employment. If you look at the Eurozone economy, the unemployment rate is 7.4%. If you look at the Irish economy, our unemployment is 4.8%. If you look at the United States, it's 3.6%. So let's assume that the UK, whoever wins, right? Both main parties, as Helen are suggesting you could have a much more expansionary fiscal policy. If you decide that you're going to build new railways, where's the workforce to build it? That's what I find odd. Normally you get much more expansionary fiscal policy, obviously, when unemployment is a huge problem. But unemployment in all of these economies is extremely low. And the related point is, I believe myself, central banks have caused more problems than anything else, because in my view, it's very difficult to get deflation in a modern economy, because to get deflation, you need falling nominal wages. Because if you look at the CPI, you look at Irish inflation right now, goods inflation is minus 1.8, Service inflation is plus 2.8. So if you average it, and roughly 50% of the CPI each, if you average it out, it's plus 0.5 and plus 0.6. So we didn't get deflation after the crisis. I believe that this perception that they're adding to the notion that we're in some kind of crisis. If you looked at unemployment, we're in a golden age. Unemployment has dropped extremely low in virtually every developed economy.
But there's no wage inflation. That's the big question to all of this, isn't it?
Yep. Yes.
No, I mean,
I think the reason is, there are lots of reasons why inflation's come down around the world: globalization, technology, demographics. But in my view, the most important reason I'd be interested with is actually the political changes that have happened over the last 30 years. The dramatic and actually unprecedented shift in the balance of power and negotiating power between labor and capital. The idea of wage push inflation, which was the main idea of the 1970s and early 80s, that inflation is caused by strikes, labor unions, etc., has completely disappeared, basically because the balance of power in the labor market has shifted so dramatically. Now, I think there are some signs that politics is shifting back in the opposite direction: high minimum wages, concerns about income distribution, etc., etc. But I think we're still quite a long way between. And I suspect we will never return to the situation of the 60s and 70s, where organized labor, unions, and so on have the inflationary role and the ability to push up wages and thereby prices that we saw for that Keynesian period, which in many other respects was the most remarkably successful period of economic history in the last, ever. And certainly in the history of capitalism in 300 years, but eventually it broke down because of that political power imbalance. Now it's shifted all the other way. I don't think it's going to revert to that.
I fully agree. I think, there's a lot of variables we can bring in to analyze where inflation has gone, why it's gone, but I think it's down to labor unions being disempowered by globalization. You simply can't go on strike and control your own market anymore, not for quite a while. Until that rolls back, living through the 70s and the 80s, we actually, we were led to believe, and we believed ourselves, that inflation was a natural phenomenon. It was the power, the increasing and incredible power of labor unions was the unnatural thing, and then the way labor unions would actually abuse that power. Now, you've got to roll globalization back to put power back into labor unions, or else you've got to have global labor unions. Unless you have either of those things happening, I think the rate at which we can expect inflation to surprise us is not the same thing as it was in the 60s, 70s, and 80s, but it can happen. And then you've got the productivity that comes with technology that's always putting output ahead. So you'd have to have a very incompetent or a very politicized central bank in the modern world to surprise you with significant inflation, I think.
Okay. Dan, I want to bring things a bit closer to home. When I look out my office window, the Dublin skyline is full of cranes. How's the Irish economy these days? We seem to be doing pretty well.
I would say clearly we're booming. I've been writing a couple of years now that, people tend to always kind of fight the last war all the time. And people talked about recovery when clearly we're in a boom. The main problem for the economy is massive capacity constraints. You can see it everywhere: public transport, infrastructure generally, obviously housing. So I think that's the big issue for the Irish economy. I think I probably will discuss Brexit, will we? But I think
we might have one question.
What worries me slightly is the fact that if you go back a year, everyone was talking about the negative impact of Brexit would have with a deal. Then it became the big risk of no deal, and then there was a kind of a sigh of relief. Okay, we're going to have a deal now, which presumably we may well have. But there's still, it still doesn't negate the problems of Brexit, I think, which I believe will be significantly negative. I think people are underestimating them. But to go back to the Irish economy, I think that the main constraint is we're at full employment. I think the main constraint on, say, building more houses is lack of labour to build them. And I think myself that the narrative which is allowed to develop about a debt, that we have somehow got a debt problem. We don't have a debt problem, that's ridiculous. Our debt is actually, this year, will be below 60% of GDP. And something Anatole mentioned, which is not fully understood enough, and that is, of course, the low interest rate environment means that you're rolling over your debt. To give you a simple example, Ireland has about 15 billion of debt that will roll off next year. The coupon on two bonds is 4.5% and 5.25%. 10-year yields have gone slightly positive again, but let's say they're zero. So, you know, that's a massive change. So I believe myself that we're missing an opportunity. I know I mentioned we're at full employment, which is a constraint, but I think if we are concerned about the environment, if we are concerned, to me the biggest environmental problem in Ireland for recent years is obvious, and that is we haven't got clean water. So why don't we borrow money and fix that? So I think it's the capacity constraints that would concern me, and a lack of real policy idea that we can tackle them.
Okay. Well, I don't want to spend too long on Brexit, because I'm sure we've all heard plenty about it over the past year, but I would like to ask Helen your thoughts on Brexit, but more specifically how you think Leo Varadkar has acquitted himself and the dynamic between him and Boris for the past few months.
They were pictured happily gambling through the woods, weren't they, on their lovely breakthrough that they had. And actually, I mean, to be fair, Leo was in quite a sticky position, I think. So this has worked out quite well for both of them. I'm not sure how the north of Ireland, or rather Northern Ireland, how one should describe it. But anyway, I'm not sure how they would feel about it necessarily, how everyone there would feel about it, because really the changes to this document, I mean, the withdrawal agreement detail.
They're cosmetic changes.
There's the Irish protocol and moving some stuff into the political declaration, and that's really all that changed. But look, so yes, it looks now, as I say, if it does get a majority. It's interesting there, of course, the Conservative Party is, you know, he purged the, you either want to call them moderates, you might want to call them Remainers, but he clearly has purged a significant group of people from the Conservative Party. It will be a more Eurosceptic Conservative Party, which is quite something, given, you know, I remember the Maastricht Treaty debacle of the early 90s. But therefore, we have to ask what kind of a relationship is that kind of government going to try and thrash out with the European Union. And I think it will, you know, Boris himself has gone on about Canada plus, or Canada minus, whatever you want to call it. But it clearly will be... I hate using this phrase, but a harder kind of Brexit, to be honest. So, look, whatever the deadline and when things get moved, and it does look like now something, you know, the implementation period we go into 31st of January. But look, then we have the new deadline, end of next year. Everyone I'm speaking to says you've got to have it thrashed out by the middle of next year to know even vaguely what the bones of a free trade agreement could be. So yet again, we are going into another deadline and another deal or no deal situation. But it's there has been a shift. You know, this Boris Johnson has look, I put it like this. We all get quite hung up about moving to the centre in politics, right? There's been quite a long period, in fact, the nice decade, as Mervyn King called it, you know, non-inflationary consistent expansion, which was the sort of early 2000s, the run-up to the crisis, led to very nice politics of Brown and Blair, which was, you know, you could spend money, spend it whatever you like, everyone has a job, lovely education, schools, etc. We're in a completely polarised world now. You know, the divisions of the referendum are never going to go away. Frankly, it was a festering wound sitting under British society for a very long time. So in a polarised scenario, moving to the centre won't win you anything politically. You have to pick a side. I think it was Margaret Thatcher who said, you know, if you stand in the middle of the road, you'll get knocked down by the traffic on either side. And, you know, I sort of come back to Thatcher because, of course, many people loved her, many people absolutely hated her. Still won 3 majorities. So there's a lot of talk about nastiness and divisiveness in British politics, but quite frankly, you go back to the 1980s, I mean, a hell of a lot of it then too. And you know, Boris Johnson, I think, is, as we know, I would say, ideologically fluid. I think, you know, his number one aim is Boris Johnson. So, you know, look, he's a good politician, whatever that term might mean, which basically means you've got to pick a side. So I just think that if, as it now looks, he will have a majority now, a proper majority of government for the first time in a few years, I suspect it will be one that negotiates a more distanced relationship with the European Union, and then, maybe coming back to your point there, Dan, you're quite pessimistic maybe about what that means for the economies.
Well, we could talk about Brexit all night, but unfortunately we're actually going to have to leave our panel discussion there. So on behalf of everyone, thank you very much to all our panellists.